Today, seeking a value anchor. Hello again, it's Martin North from Digital Finance Analytics, with this post covering finance and prop news with a distinctively Australian flavour. Today I have Michael from Emerald Financial. Hi Michael, how are you going?
Not too bad, thanks. Thanks for having me on.
Great to have you on, and always nice to have a new face on the channel. And you reached out from the other day, and there's some interesting stuff going on that you're across. So why don't we just start with a bit of an introduction of yourself and your company and what you're up to, and then we'll go from there.
Yeah, sure. I run a company called Emerald Financial Group, which holds an AFSL license. We are in the education and trading in the ASX product business. So we have a equity research and membership business for our clients, and Trader Circle, which has been established for about 15, 16 years, is a specialist in education for derivatives, where we offer membership where we lead people through an education process to make things a bit safer for them while they're training. We also run a investor relations business where we advise listed companies on their digital marketing campaigns, which has been quite successful, and all around just keeps us busy.
Great, thanks Michael. And I'm very interested in a couple of things, and I want to get into the derivatives a bit later, but I think it will be really good to get your perspective on the total market. Now, I'm assuming you're predominantly focusing on Australian equities, but I could be wrong on that.
Yeah, we are predominantly concentrating on Australian equities, but we're about to launch a US equity product. There's been a few entrants into the US equity market. The zero cost model has come to Australia for US trading, which we've found is a bit limited because you don't get to trade derivatives in the US markets, which is an issue. We have clients interested in the Toronto market, in some of the mining stocks there. The offerings, it doesn't include Canada for a few of the things that are out there, and a lot of the cost in overseas, albeit that you might get the equity part for free, a lot of the cost is in the foreign exchange transaction cost, which the fees can be between 0.6 and 0.8%. So what we do is we provide full analytics for company data, combined with technical analysis, combined with research, and with somebody you can call and have a talk about it. We're not trying to be a low touch digital solution. So you come to us.
It sounds like the absolute antidote of robo advice, right? So
robo advice. So like everybody, I've got plenty of opinions about robo advice. Look, robo advice, there's quite a few entrants in Australia, but I think they struggle to make a dollar. One of the costs of robo is the fact that a robo operating under a managed discretionary service is a retail product, and anything in the retail product is expensive on a compliance basis. So I haven't seen many numbers of businesses that run the robo, but I think they struggle for profitability. Could be wrong.
I've had a chance to look at a few, and that's definitely not straightforward. But let me talk more broadly about the Australian market, right? Because my reading on the market is it's pretty bubbly at the moment. It's pretty fully priced, and even with the results this time around, which were actually not bad, a lot of the results in for example, the banking sector were simply because they'd pulled back provisions that they'd actually taken earlier, right?
Correct.
So
we saw those come back,
the underlying momentum in the businesses probably aren't as strong as those results would do. And of course, we've got the iron ore question now, with iron ore coming off from its highs. So what's your perspective on the overall market? Are we full priced, overvalued, or is it more upside from here?
My belief, which is there's a lot of doomsdayers out there. Look, we have all the conversations about too much money printing, inflation's about to take off. I accept all the the complaints about what's going on in the system. But my belief is that nobody can change course on monetary policy. The Americans, the Europeans are going to continue to create money because they stopped worrying about a goods and services economy probably 40, 50 years ago. And the banking systems are designed around a credit creation system. And in Australia, it's all about credit creation. There's more growth in the housing lending market than there is in GDP growth by a factor of 2 to 1. So money is going into the system. Now that sounds like, oh, that's terrible. In actual fact, the answer to your question is there's a lot of liquidity out there. So you've got a federal government borrowing money, and you've got every impediment to borrow removed. So all the hard work from the Royal Commission has been pushed aside. Banks find it easy to lend. Interest rates around 2%. And we're seeing the housing price boom. That's a lot of money chases assets. So again, a long-winded answer to there's a lot of liquidity out there, and it's looking for a home. You can't. In a lot of people's minds who are looking for retirement at zero interest rates, and you've got, say, $750,000 to live off for the next 20, 30 years, you're just not going to do it. So whether you like it or not, you need to play the game with a very keen ear for the door for when the music might stop.
Right. And that's a really interesting point. In fact, I made a show earlier on today, which basically went through nine reasons why markets could well continue to move up. And the critical one is they can't stop quantitative easing, right? If they try to reverse it, everything collapses. And even the Fed, at Jackson Hole, conversation in a couple of days' time is probably going to be pretty wobbly in terms of actually a definitive move. There are one or two indicators of some central banks raising interest rates very slightly, but quantitative easing, I think, is here for the long haul. And that basically means that the financial markets are going to continue to perform reasonably well, but as you say, you've got to keep an eye for when things wobble as well, right?
When that music stops, you better know where that chair is, because if you haven't got a chair, you're gone. And I think it's just, trying to be short this market, with derivatives, we can short quite easily. We can buy puts, sell calls. It's a widowmaker trade. Let's be honest. I remember when it got down to 5,000, our clients were bears. 6,000 can't go any further. 7,000 can't go any further. Can't go past 7. Look, I think trying to go short is a loss-making strategy. It's better if you don't you stay in cash. And some people say, cash is not a particularly good idea. Well, being a derivatives person, I'd say cash is an option to buy if the market falls. So I think you could justify a reasonable allocation to cash. If the market did fall for whatever reason, escalating tension in overseas war, whatever. So cash, you can justify a cash allocation, but as long as it's balanced out with a few other assets.
Well, it's interesting because my own position is exactly like that. So, we actually are in the market, but we also have kept our powder dry on the assumption that there could well be a considerable disruption in the market at some point. Hard to call when, some people are saying September, October this year. Others are saying maybe a couple of years down the track. But point is, you don't want necessarily to be so locked in that you can't take advantage if there is a considerable price fall.
Correct.
Now that's not necessarily the sort of trading position that some would accept as legit, but I think it's a very legitimate strategy at the moment because of the level of uncertainty.
Look, if the doomsayers get their wish and the market falls 90%, everybody's gone. Cash is gone. The cash in the bank's gone. Gold is gone. March last year, gold fell, which in theory should be a safe haven asset. Everything's going to fall in a crash. So the reasonable probability is an expectation. Look, you might get a 30-40% fall like we did in 1972 when Nixon first got off the gold standard. They had a 40% fall. Then inflation kicked in, and they had a beautiful 100% run. So the reserve, the Federal Reserve, is not constrained on printing money. It's not, and I am given my knowledge of the market, I'm actually not fearful of a Federal Reserve printing money in a fiat currency. I mean, they can't go bankrupt, as some people might suggest. They can't become insolvent, so they will come in. To me, the Federal Reserve has changed the game. They have replaced liquidity with insolvency. So insolvency is off the cards because they've got liquidity. The old days, we let a few banks fail. We let a few companies fail. Insolvency ain't going to happen. It's now liquidity. So if you believe in liquidity and you're not afraid of QE, and personally I'm not, maybe in 20 years' time, depending what China does, it might be a problem. But right now, I think you could reasonably expect a good fall. Have the assets that will recover quickly, have some cash to take advantage of some bargains, and have alternatives to money like gold and silver.
Well, let's just talk about gold, because of course gold has not really done what people expected to do. So I remember interviewing Peter Schiff last year, and he was very bullish on gold, remains bullish on gold. And I've had a few other conversations over the recent years, and pretty much to a person they say, well, gold is the linchpin of value, so everything else is relative to gold. Gold is always going to be there, and that gives you an absolute degree of certainty. But it hasn't really performed as expected in recent times, has it?
Yeah, but I'm a believer in gold, and I don't see gold as, oh, geez, the value of gold in Australian dollars. I don't look at it like that. If I ask you how much you're worth, you go, I'm worth $500,000. You can change the reference to that and say, listen, I'm worth 1,000 ounces. So if you think as gold as an alternative, who cares what the currency is doing? It will go up, it will go down. If you look in a 50, 100-year cycle, the world has looked to base the value of money against something, whether it's gold, silver. Americans did a good job with oil in the 70s. So I'm a long-term, a good proportion of my funds in gold, and probably a little bit more in silver. And I don't care what the value is. We understand, as another one of your presenters make about gold, and unallocated gold, there's a lot of manipulation in that market. We know there's a lot of manipulation. Do you remember when the Redditors came in February or early March, what it was? And I remember I hold for silver, I hold ETP Mag, and it went from $33 to $40.50, like a 20% boot. And London hours next morning, boom, they just take it back down. Do what they want. I think you run a few charts, Dow Jones Gold. You look at the performance over gold in the long term. There's purchasing power parity for an ounce of gold. Buy a suit in the 1930s, you can buy the same suit today, that sort of thing. Don't be the person looking for the doubling of price in gold or silver. They're going, well, look, the high was $50 and we aren't even there. Well, now look, don't look for the $50, and unfortunately that's the mentality in this market, looking for the 2-bagger, 10-bagger sort of deal.
And it's worth saying, isn't it? There are lots of people out there who essentially are more trading and speculating than actually investing, right? And what you're talking about actually is a very different lens through which to think about investing.
And you need to think, so, we run a couple of businesses. So with derivatives trading, it's a short term, 2 weeks, a month, 2 months derivatives trading, very short term, very technically orientated. But I found my most success in my equity portfolio with a long term view. we know the world's digitising. Well, what are you going to do about it? They're revolutionising finance with the pay now, buy now, pay later. Think about that. It's been the Asian economies have been growing. The Chinese and the Japanese have been running their economies with an eye to building the economy, as opposed to the Western society building their credit markets. So their demand for commodities and minerals have been there. Copper's had a great run. Quite a fan of uranium, actually. Who is it? Is it Sprott in Canada? He probably runs one of the better allocated gold, silver. He just launched a uranium ETF,
and some of those things, and some people want lithium as another one where there is potentially a long-term story. So I guess one other question we should touch on is cryptos, right? There are a lot of people who believe that the future is cryptos. What's your perspective on cryptos? Is it real? Is it not? Is it imaginary? How do you know what the value is?
A good point. There is a crowd mentality out there in Bitcoin, so I'm not going to deny its value. I will say I'm not a Bitcoin fan. I'm probably closer to a Ethereum DeFi fan. I believe in digitization of everything. I do believe in that. And Bitcoin, I find that a bit heavy-handed. I always go back to basics with a product. I always go back to numbers. I need to understand the numbers. I understand how Bitcoin works. I understand the halving every 4 years. And I understand the revenue the miners make off Bitcoin. So just to throw a couple of numbers at that long-winded way to answer your question is the Bitcoin miners are paid about 1,000 Bitcoin a day to maintain the blockchain. It's about 997 at the moment. And the current annualized cost of running the blockchain is about 12 billion a year. All these statistics are published by blockchain.com or .org. They tell you the number of transactions being transacted. So if you're telling me that I invest, and I know the price of Bitcoin's going up, and anything goes up must be good, but if this Bitcoin system's charging $12 billion a year to run, and that's escalating at the current rate, it's running at about 17 billion at a current run rate. That's about with a market cap of about 1.2 trillion on Bitcoin. That's about 1.5% management expense fee to run the thing. So I just see an inefficiency there. It's only transacting 103 million transactions a year. That's an exact number as of yesterday. 103 million, whereas the Visa card, MasterCard, Diners, Amex, they're transacting 480 billion transactions a year. So I don't see Bitcoin as a replacement. I think it's a great speculative asset. I see all the analysis based on the fact that because the price has gone up, the Michael Saylors of the world, because the market's gone up and it's outperformed everything on this planet, it's a good reason to buy it. So, but you can be the person who bought it at 65 and seen it go back down to 28 recently. So, look, I think it's too volatile. When the question about Bitcoin is it a replacement for money? Money, as much as we criticise fiat currency, money is the fiat currency of the US. The fiat currency of China and Russia is protected by those countries and by their defence systems. What's protecting Bitcoin? Bitcoin is an unregulated product in Australia. It is not a financial product, and a few ASX listed companies have found that out. It's not regulated, and don't start playing around with Bitcoin. Do not put the word Bitcoin or crypto in your ASX announcements, because we'll ask you to remove it. So it's unregulated. the Australians aren't going to be in any hurry to legitimise crypto. And if you're a financial services license and you want to introduce crypto trading, the first call you should do is to your professional indemnity insurer, because he probably won't cover you. So I think the idea is brilliant. I love it, and I have 100% belief in it. I think if you can disintermediate a lot of these finance contracts or self-executing finance contracts, I think it's not dissimilar to what happened, you know, in the construction of the Eurobond market from 40, 50 years ago. Another story, but that was basically an off-market US dollar system. So these off-market currency systems can work, but they're all now want your AML identity, your AUSTRAC, you're registered, and the poor buggers who brought down that pipeline and got $6 or $7 million, the FBI said, "Oh, we just took it back." so tell me it's safe. Anyway, so there's a different perspective on Bitcoin, a belief in blockchain, a belief in DeFi. I don't think it's priced well yet.
No, it's very interesting. And look, my perspective has always been that the fundamental discontinuity that can be created with the blockchain and the distributed finance is very powerful. But the instance, which is blockchain, or the other 10,000 coins that are out there, aren't necessarily the ultimate end game, right? It's sort of a journey towards a very interesting future where effectively maybe banks won't be the same as they are today. Maybe even central banks won't be the same today.
Well, they won't be. Yeah, you agree. Yeah. Look, and my view, I think, I have a different view that Bitcoin blockchain has been introduced to ready the world for central bank digital currency. And maybe because we've touched on it, I think what's happening, and you're seeing it, the most logical conclusion for central banks to go to is a central bank digital currency. And why, you may ask. What's happening is that with this QE, constant QE going on, and it'll grow larger, the technical problem with QE is when they buy the government bond, they take the 10-year, they give you a cash deposit in return. Whoever the investor is, then instead of having a 10-year bond, now has a cash deposit. And they put that cash deposit onto a bank's balance sheet. And then the bank's got to balance that off in his reserve dealings. Now, the problem is that when you put $1 trillion on your balance sheet from these deposits that are being created, you've got reserve requirements. You've got net leverage ratios, you've got capital adequacy. It costs you money to put stuff in your balance sheet. So you may have heard, I'm not too sure, whether of the repo problem in the US.
Absolutely.
Have you heard about that? Yeah.
Yeah, so, covered it several times on the channel. Yep.
Oh, have you? Oh, okay. So, well, tell me if I'm off base here, but now a lot of people are saying, "Oh, there's problem in the repo system. You got the Federal Reserve doing a copious amount of QE, and they're doing reverse QE with their repos." Anyway, so I disagree with that. So basically, what's happening in the US, if you find a couple of the more repo commentators out there, is that the US system is trying to circumvent, I believe, the banking system. So in America, they've actually got money market funds, and the money market funds are not banks. So when they take $1 trillion on deposit from all these clients who just sold their bonds, they are looking to lend it. They are looking to lend that money because they've got it from deposit from their clients. The only person they can lend that to is the Federal Reserve, and the only thing the Federal Reserve can give in return is repo. So it's much better for your balance sheet for the banks to say, no, look, just go to the money market funds. They can take it directly to the central. If you come through my books, I've got plumbing problems. So if you look, have a good look on the research on there. The US have got plumbing problems because they've just got too much deposit, which I mean unproductive deposit. I mean, the old you can't borrow short and lend long. The old the old syndrome of banking syndrome. So again, and some of the doomsdayers, saying reverse QE is all a joke. I can see why it's happening, and so the way around all that is that eventually, to disintermediate the banks from all this QE, the way to disintermediate the banks is to do a digital currency. So you put your deposit, me as a private citizen, I will put my deposit directly on deposit with you as a digital currency. Now, there's obviously privacy issues with that. The bank knows how much money you've got. I think they're pretty much there anyway with AUSTRAC and AML. So, and the Chinese definitely want to do the digital currency for tracking reasons as well. So the banks really are useless intermediaries. I mean, the traditional role of the bank was what they call maturity transformation. They took the deposits, the 30-day deposits from their clients, and they turned it into 2, 3, 5 years loan. Their job was maturity transformation. That has all gone out the door because the 3-year rate in Australia was 0.1% and the deposit rate was 0.1%. So pretty hard to intermediate that. So I think the future is the central bank digital currency, direct control, and a bit more strength for the government.
And it's interesting because, of course, what they can do then is everybody has a central bank digital currency at the central bank. They can put money directly in that, which means they can disintermediate the banks completely, right? Yeah, which means they can get the money out into the real economy rather than it getting caught in the system, right? Which is where it is at the moment, because the repos example. But the other point there is they've got greater visibility, greater control, and you could even get to the point where they actually could direct what you could spend it on, for example.
Correct.
Right?
As they did with the Aboriginal community debit card, that was directed that they could only spend it at certain stores. Now, there was plenty of complaints about that, but all the ideas come to the fore. So you can say, look, here's $1,000. It expires in a month. Spend it. You can't buy alcohol. You can't buy, non-ESG product. Go and spend it, and they can.
Yeah, absolutely. And then you couple that back with continued QE, right? So they continue to create more of the currency, right? They then push it out through the central bank digital currencies. Yeah. They direct it as to where you can spend it and what you can spend it on, and therefore they've now got complete control of the entire monetary system, right?
Correct.
Now, the point to make about that is the end game. You can see it in China, it's already happening, right? And then you can begin to think about how that links into surveillance and, cameras on the high street and all those things together, right?
Absolutely. Yeah. Because I'm trying to be an honest taxpayer, I actually don't mind the surveillance from that point of view, because I'm not doing anything silly. But it will get rid of, if that comes in, when the plumber comes around and you give him $50, that's out the door. You'll have your one bank account, and it will predominantly get rid of the black economy, as long as they ban cash over $50, like India did a few years ago.
Well, and of course, it also depends on how politicians can actually make those under the counter. Oh, we won't say that.
We won't say that. No. They'll make an announcement to say the opposite, and then just do the opposite, because that's generally how it works, isn't it?
No, it is. But this is a very serious point, and there are enough papers out there, if you go look, of people thinking through how this central bank digital, and by the way, central bank digital currencies and negative interest rates actually come together, right? Because what you can then do is essentially, you've caught all the flows in the economy, you can then control the rates, and that gives you then capacity to cut rates even more. And
it's a form of taxation.
It's a form of taxation, absolutely. Right. And more importantly as well, as you said, they can put a time limit on the value, or they could actually notch the value down over time. So if you don't spend it next week, it's worth 90% or whatever, right?
Correct.
So it gives you a whole bunch of additional monetary policy tools.
Yeah.
Right?
That's right.
And that,
the and my view of, like when the government borrows money, what it does when it's paying its 1 trillion stimulus, all it does is put $1 trillion into people's banks, and then that makes them overdrawn on their Federal Reserve account. Now, traditionally, they've said, listen, we'll go and fund that with 10-year bonds. It's a courtesy. They didn't have to do it. There was some demand from investment companies who'd wanted long-term assets, but they don't have to do it. If they could borrow all their money on what we call one-day money, on deposits, and they're controlling it through a central digital currency, they don't have to issue bonds anymore. They can just issue, we call one-day money, and then full control, do what they like.
Yep.
And as you say, if they go to negative interest rates, and I think Germany at the moment is negative 0.5% for 10 years. You think about it, if they go negative 2%, that get back to your friend Steve Keen's idea of debt jubilee. In 50 years, 50 times 2% is 100%. So, there's plenty of opportunities to do something there.
Absolutely. Yeah. Now, well, it seems to me that is ultimately the end game, because we've said they can't stop doing the QE, right?
Ain't gonna happen.
We know that the current mechanisms are actually just creating these liquidity traps that we spoke about earlier on.
Yep.
But the central bank digital currency and the negative interest rates and those things are a way out of the hole, right?
Correct.
And it plays in the game of more government control, more ability to be able to actually direct what's going on. And my own view is that where governments have a choice of doing more or less intervention, more or less control, they tend to go for more control rather than less control, right?
Well, that's exactly right. So, we've seen it in our housing market, which has been a bit despairing. So, and Canada too this week, they're saying, we've got to stop the housing bubble. So they've announced that you can save $40,000 tax-free, and you can use it for the purchase of your home. Not dissimilar in concept to our first home buyers grant. Now, the last thing a roaring bull market in property needs is further price incentive to bid up the price of house and land packages.
Yep,
so all they've done is lower the LVR, lower the responsible lending laws, increase incentives for people to pay higher prices. They are just keeping that bubble going because they see the economy needs this credit creation. The credit needs to keep growing to keep the economy afloat. If the credit creation went backwards, obviously the gross domestic product figures would have a tougher time, and we'd be in technical recessions. So, and the other thing they're juicing up is the property market. And this is a bugbear of mine, where our reserve banks around the world, the Western reserve banks, have moved to a credit, growing the economy through a credit increasing rather than doing goods and services, whereas China, Japan, Vietnam, South Korea have all moved to credit creation with central bank guidance as to what they should lend their money to. And just to pick up an interesting point that pops in my mind with that, interestingly, Germany is one of the better countries in the world for banks. I think they've got about 2,000 banks, and 70% of the banks are community banks that are locally owned, locally operated, and they lend to the local community for business. And what that does is it's a banking system that serves the community, and it creates jobs, it creates businesses. Germany is at the small SME level is one of the biggest supplier of high technical product to the world because of this SME philosophy. So whereas, as you'd appreciate, most of the banking systems in the world have congregated up to the top. So Australia's got 4 banks controlling 80-90% of the lending market. You got your big regionals like Bendigo, whatever, trying to compete with not at a real community level. I mean, at the end of the day, they still just want to lend on home loans. They're not lending to a small business to start a business. Everything here is based on property as security against the loan. So I think that if our government wanted to be serious about moving away from this credit creation economy, and moving to a lending for goods and services, small business, love to give our teenage kids apprenticeships, that sort of thing. I think that's what's missing in the market. If you were going to do something about it, but as you'd appreciate, it ain't going to happen.
No, absolutely. Well, of course, the political parties are so aligned to the big banks, right? It's all sort of, the same old, same old. And I keep talking about the real economy versus, housing, and I've defined a few times the Australian economy as a housing market with a small economy bolted on the side, right?
Correct.
And the other side of it's the resources sector. So that's basically what we've got, very narrowly based. But there is no political appetite
whatsoever
to change that game.
That's right.
And it's a policy setting that's been in place for at least 30 years. It's a policy setting that's created this artificial wealth effect because people have seen property values go up. But one of the things I say is you only need one house, right? And if you think about the value of that house, right, what's actually happened is you've had to throw a whole lot more money in today to get that same house than you did 20, 30 years ago.
Correct.
That's a different way of thinking about this, which actually wakes people up sometimes.
Well, the thing is I think our our society now thinks of capital gain as income. It's not, I'm going to invest in the house and they'll go up in price. So like 10 years ago, a house cost about 10% of the price it costs now. But invariably, as they wanted to send their kids to better schools, as they wanted to buy new cars, as they wanted to do holidays, everybody has monetized their increasing value of their product. I shouldn't say everybody. A good proportion of people have monetized increasing value of their property, so that their mortgage they had 30 years ago is now 10 times the value as well. And so they've coming into their retirement, got their kids through school, but they're still carrying a large mortgage. So they've monetized the capital gains, and this is what's happening. Oh, you got a credit card, pay it off, refinance your home. So the problem is that to the extent of what I said is true, that they've converted the capital gain of the house price increases to 10 times value into income. They have turned it into income. What's the expectation for the next 30 years? Where will that income come from? Because prices aren't going down, are they? And if you've got any kids, I've got 3 children in their 20s. One just got to 30. Yes, they're going, holy hell, we can't afford to buy a house. You and I probably got our educations for free, including Macquarie University for me. And I think it cost me $1,200. The guys who work for me are still paying off their HECS at the age of 30. So that's taking 5%. The take-home pay, I know, just covers their expenses and a little bit. How do you save 20% deposit? So the millenniums are sitting back going, okay, well, it's probably a good idea to, what money I have is to try and go into the share market and have a go at trading. And we've seen a boom, as you probably know, in retail trading. It's all the retail stockbrokers, CompSec, Self-Wealth, Open Markets, CMC, they've all boomed. A lot of people are engaging with the share market because why not? If they could double the money, that might be their entree to the housing market.
Well, I've seen people even say the same with regard to Bitcoin. But the point that's worth just thinking about is how debt is now wired into the psychology of society, right? From HECS debts for university, credit cards, people are even in school taught about credit and what have you, right? And it's almost like that's the way you do it, right? No, it doesn't have to be the way you do it. It's the way that we've been taught to do it.
Correct.
And of course, the financial institutions love it, because what we're actually turning into is a series of cash flows over our life, right? As we service all of those debts into the future.
Yeah.
And what that essentially means is that they've now got certainty of income. Net present value of all those future flows is the value of those customers. But individuals have less and less choice, firstly, because they have to play the debt game if they want to get on. But the other is we're also excluding a lot of people who aren't able to play that debt game because either they don't have the financial wherewithal to start, or they don't have the education or the expertise, or they are trapped into some of these high debt alternatives. I mean, even things like you mentioned Afterpay and the other payday, buy now pay days. Buy now, pay later solutions, those can be a real trap for some people too. So we've actually got this society that's completely warped because of the financialization processes that we've touched on, right? And that's when I come back to, hang on a moment, we've lost the plot. We've lost the plot for what society is about, what the economics in society is about, and what the role of finance and banks should be, which then says, we're not going to find a way out of this unless there's a complete circuit breaker or a different way of thinking.
The circuit breaker in our society, as it stands, our political, it won't change. People, in America, when people couldn't afford their car loans, they did a financial trick. They extended a car loan from 4 years to 7 years to make it more affordable. We interest-only loans, you don't have to repay principal. So as you say, everything we've doing is trying to get our future income and bring it forward to today. Every financial mechanism available is going. And the perverse thing out of all this, that if you look over the last 30, 40 years, no bank fails. Every bank is saved. You go through, the recession, the crashes, the GFC, every bank was saved, the liquidity versus insolvency. So you can do anything stupid you like as a too big to fail bank, and you will get saved. So why not irresponsibly lend? Why would you care? So, and I think the doomsday is out there saying, well, if interest rates get to 4 or 5%, it's all over. I'd agree. If it got to 4 or 5%, it would be over. I just don't think it's going to get to 4 or 5%. So it's just going to keep on rolling. And we need a change in government. How does that happen? Well, some people have to get very angry, I think.
Yeah, and perhaps some anger will come from, unfortunately, pain and discomfort as some of these things play out, because I'm certainly seeing more people struggling with those debts that they've been saddled with for quite some time. And of course, the responsible lending obligations, they're trying to wind those back and say, no, it's your own problem. You as an individual commit to the debt and it's your problem. But actually, this is a societal problem. It's a structural problem. Yeah.
And no political will to get rid of it.
No, absolutely right. No. Well, look, I've really enjoyed talking with you today, Michael. We didn't get on to derivatives. I think we'll have to do that as a separate conversation.
Yeah, certainly.
I love talking about derivatives. I taught derivatives for years, but
good.
It would be good to sort of talk about some of those things. But I think in terms of to draw this to a conclusion, it's a really interesting time. The markets probably have some upside from this point because quantitative easing can't be unwound.
I think so.
But the broader socio-political economic implications that we've touched on, I think are really important for people to reflect on, and I really enjoyed speaking with you about it.
And I appreciate you inviting me on, and it's been very enjoyable. Fantastic.
Right, and just if people want to find out more about Emerald, where do they go? emeraldfinancial.com.au is a starting page to all our other websites. It gives you an idea what we do. We're a member-based business. We're about long-term relationships. We're not about just putting a trade on. So if you like the long-term conversations, we're probably good people to talk to. Terrific. Well, thanks. I'll put the links below. Enjoyed speaking with you, and we should pick up the conversation down the track.
I'd love to. Thanks very much.
Thanks very much. Take care.